There's two main kinds of crowdfunding which can be very relevant to businesses in the UK today. If you're an early stage business who isn't profitable yet, who's really starting out, you can raise money through equity crowdfunding, and it's a bit like a group of angels investing online. Or if you're a more mature business with steady revenue in place, you've got an option to borrow money through peer-to-business lending. Having a known name or brand is not a prerequisite for crowdfunding. I think it can be advantageous for some of the earlier businesses. But crowdfunding is a means of getting financial backing, but also the backing of those customers and establishing your name. When you're crowdfunding, you are going direct to investors and customers and asking them to support your business. So it's important to give them sufficient information for them to be able to assess what the business does, how it might make money, and also what might go wrong. The information tends to fall into one of three buckets. One is people want to understand about the management team. Have they done this before? Is this a credible group of people? They like to know more about the product or service that you're producing. And then, of course, there's the financial information as well, particularly how well a company's done in the past and what it thinks it might be able to achieve in the future. Now, these are online platforms, and videos are a very popular way of getting that across in just 2 or 3 minutes. So people who are still browsing and choosing which businesses to back can have a very simple and engaging way of taking a look at what's on the market and where they might want to put their money. Companies are likely to want to choose a crowdfunding platform that's regulated by the FCA, and therefore that platform has a responsibility to make sure the information the business puts up is fair, clear, and not misleading. And they will also ask to check any claims that you make in your pitch. So financials are fantastic. If they can be audited by a third party, that's very reassuring for an investor. So one of the aspects of crowdfunding which can be very attractive to a business is the speed that it goes at. So it can be a 30-day process from start to finish to raise your money. And these investors may often become customers at the same time. So it's a large number of people with a small amount of money backing your business. If a business is thinking about equity crowdfunding or any equity raising, it's important to have a view of all of the funding requirements through the lifetime of the business. So crowdfunding may be the first step, but there may well be venture capital coming at a later stage. So being realistic about valuation is important, and maybe considering some of the blended models now where you see angels investing alongside the crowd. It's worth starting with the UK Crowdfunding Association website and just looking to see the range of platforms which are available. I would choose a platform which has a strong track record in your particular industry, whether that's pubs or technology. And I would also think about whether you have any investors of your own that you can bring along, and that'll help you negotiate better terms with the platforms. I think one of the more common misconceptions about crowdfunding is that it's simply a question of putting your pitch live and the money will come flooding in. So if you have 60 days to raise the money, take half that time and prepare your pitch and your business plan and your numbers. Get some help and advice, because when you go live, you will get asked question after question, real time, online by the crowd, and you need to have your answers ready.